Ladies and gentlemen, good day and welcome to the Kalyan Jewellers Q3 FY22 Earnings Conference Call hosted by ICICI Securities Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Aniket Sethi from ICICI Securities Limited. Thank you, and over to you, sir.
Thanks, Faizan. Good afternoon, everyone. At ISEC, it's our pleasure to host the Q3 FY22 earnings call of Kalyan Jewellers. The company is represented by Mr. Ramesh Kalyanaraman, Executive Director, Mr. Sanjay Raghuraman, CEO, Mr. V. Swaminathan, CFO, Mr. Sanjay Mehrotra, Head of Strategy and Corporate Affairs, and Mr. Ibrahim George, Head of Treasury and Investor Relations. With that, I'll hand it over to Mr. Ramesh for his opening remarks. Post that, we'll open the floor for questions. Thank you.
Thank you. Good evening, everyone, and I'm very happy to meet you all again. Hope everyone is safe and healthy. The recently concluded quarter has been very encouraging, and we witnessed strong revenue growth momentum across India, Middle East, and our online business. Gross margins improved sequentially for the recently concluded quarter, and it is in line with the trend which we have witnessed in the past several quarters. We are encouraged by the expansion in gross margin over the past 2 quarters, especially as it is nearing our pre-COVID levels. Key drivers for margin expansion in India have been improvement in both studded share and share of revenue from non-South markets, and our studded share saw a meaningful growth sequentially as well as when compared to the same period in the previous year. We also witnessed improvement in our gold savings scheme enrollments sequentially as well as when compared to the same period in the previous year. Share of revenue from My Kalyan has also improved sequentially, and it is settling down around the pre-COVID levels. Expansion for the current year has been on schedule. Out of the 21 showrooms planned for FY2022, 15 have already been opened, including 5 showrooms in Q3. We continue to be encouraged by the performance of our recently opened stores, and we believe this bodes well for our expansion plans going forward. The next update I want to give is about our franchisee initiative, which I mentioned in our previous earnings call. We believe selectively exploring this route in certain regions in India will enable us to further accelerate our growth profile, and as well as this will expand in a capital efficient manner. We are currently in the final stage of selecting and performing diligence on the first set of franchisee partners. This will be a pilot project, and once the model is validated, we shall ramp up the franchisee stores during the year. In the initial phase, we will be following the franchisee-owned company-operated model. Now let me give you an overview of the current operating environment. First of all, let me highlight the fact that we started the ongoing quarter on a very high base. Our revenue growth was over 60% in Q4 of the last financial year, and if we look at only January, the growth was in excess of 35%. January this year has seen showroom closures due to COVID, especially during weekends. Only 82% of our showrooms were operational on weekends, and on an average for the month, about 94% of the showrooms were operational. Even with this background, the revenue growth has shown good momentum when compared to January 2020. But when compared to the previous financial year, the January numbers have seen a marginal degrowth. Post-January, we are seeing removal of lockdowns in most of the markets, and also recovering demand. But there have been fresh lockdowns announced in Kerala, which we hope will be lifted soon. To conclude, a lot of celebrations have been pushed to the second half of this quarter and possibly to the next quarter. Given the resilience of our sector, which we have witnessed in the past, we expect strong demand recovery for the rest of the season. Overall, we are continuing to feel good about the business and our operating performance. I'll now hand over to our CEO Sanjay to take you through the Q3 financial performance. Thank you. Over to you, Sanjay.
Thank you, Ramesh. Good afternoon, everybody. I'm really happy to be talking to you all after a great quarterly performance. For the just concluded quarter, our company reported consolidated revenue of 3,435 crores, a growth of 17% over the corresponding quarter in the previous year. Consolidated EBITDA was 299 crores versus 288 crores in the corresponding quarter of the previous year. And consolidated profit after tax PAT came in at 135 crores versus 115 crores in the corresponding quarter of the previous year. Now, let me give you the breakup of the financial performance between India and the Middle East, starting with India. For the just concluded quarter, our India revenue was 2,880 crores, a growth of 15% when compared to the corresponding quarter of the previous year. And the India EBITDA for Q3 was 253 crores compared to 247 crores when compared with the corresponding quarter of the previous year. There were certain one-time expenses comprising showroom write-offs due to relocation and a one-time bonus in the previous year. Normalizing for this, the India EBITDA growth would have been about 5%. Our India business PAT came in at 118 crores compared to a PAT of 94 crores in the corresponding quarter of the previous year, a growth of 26%. Moving on now, I'll share some information about our Middle East business. Our Middle East revenue for the quarter was 515 crores, a growth of 24% compared to the corresponding quarter of the previous year. And the Middle East business delivered an EBITDA of 46 crores versus 31 crores in the corresponding quarter of the previous year. The Middle East business posted a profit of 16 crores for the quarter compared to a profit of 12 crores in the corresponding quarter of the previous year. Talking next about our e-commerce business, Candere. We posted a revenue of 47 crores versus 34 crores in the corresponding quarter of the previous year and recorded a PAT of 26 lakhs versus a profit of 2.7 crores in the corresponding quarter of the previous year. During the quarter, we had no bullion sale and our gold coin sale to retail and corporate customers was 82 crores, which is about 2.9% of our total revenue. With this, I'm done with the summary of the financials and we now open the floor for questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The first question is from the line of Gaurav Jogani from Axis Capital. Please go ahead.
Thank you for the opportunity, sir. So my first question is with regards to the margins in the Middle East business. So I think those have contracted a bit on a QOQ basis. So what is the outlook here? Is there any one-off in that? And how do you see margins trending ahead in the region?
Yeah. So Middle East margins, quarter on quarter, there has been a small degrowth. That is predominantly because now the revenue growth is there. Tourists have started coming. So automatically when tourists come, they demand for product which is at the lowest making charge. Because for them, basically, they try to get it at a price which they get the duty advantage when they come and shop there. So there are certain products, especially for the tourists, which we display there, and that is why the margin degrowth was there in Middle East. Otherwise, within segments, the margins were actually the same.
Sure. Sir, what would be the outlook going ahead? I mean, now hoping that the things remain normalized and there will be inflow of tourists and business will be as usual. So should this be taken as the new steady state margin run rate, or there is possibility of improvement further on?
Yeah. So initially pre-COVID, the margins were in the range of 13%. Post-COVID, the margins went up by around 17%. So now going forward, we should look at a margin at this level, meaning in anything between 15 and 16.
Okay. Got it. And sir, if you can, sir, I missed some numbers initially with regards to the January performance. So if you don't mind, can you please repeat that?
So January actually started with some lockdowns, especially during weekends. During weekends, only 82% of the showrooms were open in Jan. Overall, January, 94% of the stores were open on an average. But even with this background, the revenue growth has shown good momentum when compared to January 2020. And January 2020 had a 35% plus growth in the last financial year. But when it comes to January this year versus last year, there is a marginal, because when stores get closed, there will be an immediate impact on demand. And a lot of wedding and wedding related stuff, we believe, has been pushed to the second half of the quarter and a few to the next quarter as well. So this demand is not going to go away, it is going to come back. But yes, January we have a marginal degrowth when compared to last January. And last year also, if you see, it was very similar, meaning lot of demand had been pushed to April. And that is why we had a very good March in the last financial year.
Okay, sure, sir. Sir, and with regards to, I mean, now the non-South also has done pretty well in this particular quarter. I mean, traditionally also, I think Q3 is bigger for the non-South area. So how is the trend you expect going this ahead? So this ratio that we have seen in this quarter, is this expected to remain at this level in terms of the non-South contribution?
Yeah, so the South non-South contribution depends upon season to season. So Q3 has always been a non-South quarter, wherein Diwali, Dhanteras, etc. are celebrated more in non-South market. And this year especially, we had actually a better non-South growth than in South. All put together, the non-South revenue share has grown. But on a yearly basis, it should be in the range of 35%. That is what we should look forward.
And sir, the new customer addition in the last two quarters have been really strong, and you mentioning that that's been close to the vicinity of around 50% plus. So how has been the trend now? And also, Titan actually reported its numbers yesterday, and they had also alluded to strong new customer entry growth. So, if you can comment something on the industry per se, and how is the situation with you too?
Then the new customer addition has been very robust. The share is now approximately 37 to 38%.
And you continue to witness the same. The traction continues to witness the same. And what is this led by?
It is very similar for the past 4 quarters now. It has been contributing in the range of 37 to 38%. It was not as high as it was in the COVID times, where the first quarter of the second quarter last year. But 37 to 38% is much higher than the pre-COVID.
Sure. And so just one last question from my end, then I'll get back into the queue. Sir, in terms of the, what would be your outlook going ahead, given, the Q4 will be having a higher base now. So how do you see, and plus you have already alluded, that January has seen some marginal degrowth. So how would be the outlook going ahead, and what are you seeing on the ground, if you can highlight something on that side?
So if you look at now, January, the markets which had announced lockdowns, now it has been withdrawn. But in Kerala, there is lockdown which is announced in weekends. But the wedding resilience is very high. We expect quick bounce back because the wedding and wedding related stuff has been pushed to the late of this quarter and for the next year. I think we are, of course, on a high base. Last year growth was around 65%. But we are even now positively looking forward to this quarter.
Okay. Sure. Thank you.
Thank you. Reminder to the participants, anyone who wishes to ask a question may press star and 1. The next question is from the line of Shirish Pardeshi from Centrum Capital. Please go ahead.
Yeah, hi, good afternoon. Ramesh, good afternoon, Sanjay. Thanks for the opportunity. Just 2 questions in the beginning. If you break down this 17% growth, for my understanding, what is the absolute tonnage growth and grammage growth, if you could share? And is there any price element or realization element in the 17% growth?
So if you look at volume growth, it would be bigger than the revenue growth this time, because actually the price has come down by 4 to 5%. So the volume growth will be in the range of 20, because the ticket size have remained more or less the same.
Sorry, I missed. There was some disturbance. Can you please repeat?
If you look at the ticket sizes have remained more or less the same. Metal price has come down by around 3 to 4%. So the volume growth will be in the range of 21 to 22%.
Okay. Got it. And if you could share the studded portion, which you have mentioned that there is improvement which has happened. So can you specifically say that what is the studded portion for the entire company today, and what was it in the last year, 10 quarters?
Yeah, so now for the Q3, the studded ratio is 25.5, and it has improved. Last quarter, it was in the range of 24. Last Q3. Pre-COVID, it was in the range of 26 to 27. Same Q3.
Okay. Like you gave the January number, can you break it down October and November number by month, how the India growth has happened? I mean, I do understand second half of December there was some panic in the metros and semi-metros.
Yeah, so actually October to November 10th, where till Diwali, we had a very good growth. November post Diwali, we had witnessed some softening in demand, especially because during that time we had some flash floods happening in Chennai and Kerala. But from that, December, we saw demand picking up again. And December last week only we saw lockdowns in metros, but it did not impact our December revenue. December also we grew. double digit.
Okay. And my second question, despite we have done a lot of activities and gold metal loans, what we have tried to get, is there any tangible benefit which has started coming and showing up in the numbers? Because the number when I do, there is not much difference which has happened.
So gold loan levels have been almost similar for 2 quarters now. The interest benefit which we have got is actually because of good negotiations which we have done with the banks. So there have been reduction in our interest expenses. It is not because of the gold loan difference. It has been almost similar for the subsequent quarters, like the previous quarter versus this quarter. The major advantage which we have got is because of negotiations with banks. But when you compare with the previous year Q3, there has been GML increase. That is why you see substantial interest difference between Q3 of last year versus this year.
Okay. My last question is on non-South market. Obviously, it is heartening to know that you have grown almost 25% on a YOY basis. But specifically, if you can give some more detailed commentary, which markets, which locations, or is it primarily because our non-South stores expansion was there that has added, or it's a pure play, the same store sales growth? Not exactly the same store sales growth, but is the similar stores still showing the growth momentum by addition of customers?
So here, actually this year expansion, South has been bigger than non-South, so that is not the reason. The major reason is that last year, actually we had grown more in South than in non-South. Because last year, there has been lot of migrations happening, wherein customers who are, for example, in Bombay, a South Indian, they came back to Kerala and resided for some time. So that revenue came back to us in South rather than non-South. The non-South migration we cannot completely absorb because we are not there in all Tier 1, Tier 2, Tier 3 cities there. For example, a person in Bombay, if he moves to, say, South India, we can actually get that revenue. But again, internal of Maharashtra, if they move, we cannot gain that market share. We could not last year because we are not there in all Tier 2, Tier 3 markets in outside South. So the major advantage which we have got this time, the growth in non-South markets, is because first of all it was a lower base, and now there is no migration happening. Customers are there, so it is a gain because of that.
Sure. Thank you. Wonderful. All the best to you.
Thank you.
Thank you. The next question is from the line of Deepak Poddar from Sapphire Capital. Please go ahead.
Thank you very much, sir, for that. Sir, I just wanted to understand in terms of EBITDA margin. How do you see EBITDA margin over next 1 to 2 years? So any thought process on that would be helpful.
Yeah, so you can improve your EBITDA margins in two ways. One is increase your gross margin when you sell. That is an upside. Second is operating leverage stepping in. So we see both as an advantage for us because our expansion is majorly going to be in the non-South markets where traditionally the margins are better than South.
Right.
So there is going to be a margin expansion there. Secondly, when the revenue goes up and when your corporate overheads does not grow parallelly with it, you get a benefit of operating leverage. Both put together, we think that it should be improving around 3% in the next 2-3 years.
3%. Okay. So currently, I think adjusted basis 9% was our EBITDA margin. So
yeah,
we are looking 12% EBITDA margin maybe next 2 to 3 years, right?
Yes, correct.
Fair enough. All the very best. That's it from me.
Thank you.
Thank you.
Thank you. Participants, to ask a question, you may press star and 1. The next question is from the line of Aejas Lakhani from Unifi Capital. Please go ahead.
Yeah, hi. Thank you for the opportunity. So my question is more on capital allocation, and if you could speak a little bit more about, the piloting of the franchisees that you have spoken about. How many franchisees are these? Are you experimenting uniformly across the South and non-South markets? And what will be, what will be the key success factors that will determine your thrust into this area? Thanks.
So franchisee basically will be in non-South markets, not in South markets, because South we are already penetrated and we can top up stores by ourselves. Because our expansion also we would like to do it in the non-South area. That is our primary intention. And actually the franchise is an accelerated plan. We had initial plans only to launch it after a couple of years, but by the trend which we see now, by the shift from unorganized to organized, we wanted to go before the plan. So that is why franchisee came into action. So franchisee, it will be basically a franchisee-owned, company-operated model. That is what we are looking forward for the initial set of franchisees which we are going to do.
Got it. And sir, wanted to understand that, how, so if it's possible to share how many franchisees are we looking at in the first pilot phase? And, how are you going to measure their success for you to be able to really scale up this FOCO model?
Yeah, so the initial pilot phase we would like to do into 2 or 3 locations. All in non-South markets, locations have been identified. And if the pilot franchisee is as per our plan, then scaling up is not going to be a major task. We will scale it up.
Okay, got it. And sir, just wanted to understand also that, I understand that this would be, in terms of advertising, this was a slightly more heavier quarter. But, as a percentage of, if you look at the standalone sales, this quarter has been 2.5%. So I wanted to understand that, is there any measurement metrics at the company level where we are able to validate that the ASP spends are actually translating to sales, while it's helping us in branding? But is there any measurement way to actually validate that there is a conversion of the ad spends to sales?
Yeah, so first of all, the advertisement expenses over revenue, we would like to keep it in the range of 1.8 to 2%. And each quarter it will be different because it's a Diwali or the festive plus wedding. Usually the percentage of advertisement on revenue will be a bit more higher in Q3. And the Q3 last year is not comparable because we had just come out of the COVID and the industry was, every player was spending very less. So advertisement expenses will be in the range of 1.8 to 2% on a yearly basis. And on your question as to how we get to know whether an advertisement is working, we do have internal analysis which we do, wherein when a customer comes, we really ask them the reason for shopping, whether it is for wedding or whether it is for gifting or something, and also again why he stepped into Kalyan, whether it is recommended by somebody, whether he saw any commercial, whether it is because of any offer, internal offers. So we have a system in place wherein we actually look at the efficiency of campaigns, and then with that workings, we plan the next set of campaigns.
Got it, sir. Okay. Got it. And any thoughts on how you see the business panning out? You mentioned it at an EBITDA, sort of from an EBITDA perspective, you see a 3% improvement for the domestic, for the Indian business. But do you have any forward-looking guidance that you can help investors?
Yeah, so that was a forward-looking guidance. Actually, meaning it is not only India, Middle East are also in the range of 9% now, EBITDA margins. So margins will go up by at least 3% in the next 2-3 years because, first of all, our expansions are all going to be in non-South markets. Second of all, the operating leverage will surely step in because every additional revenue, the margins is going to directly flow into your bottom line.
Got it. And sir, could you speak a little bit about, the industry is moving to the hallmarking. So what is the progress on hallmarking today? Has it been strictly implemented or is it still, slack like how it was in the last quarter?
Yeah, Sanjay.
The progress, the update here is that hallmarking and the HUID implementation is complete from a perspective of the hallmarking agencies, 100% complying with that. Surveillance activities by the BIS authorities have also started in some states wherever possible on account of COVID. If there are issues, it's not being done as strictly, but in many states, visits from BIS authorities are beginning to take effect. All ornaments have the HUID code as well as the hallmark the way it is supposed to be. Even from an infrastructure perspective, earlier there were some issues with the hallmarking agencies not being able to cope with the demand. Even that's now, a thing of the past. So even that kind of resolved. In summary, it's kind of stabilized now, and this is going to lead to the shift further accelerating towards us in the organized sector.
Right. That's very helpful. So if you're just, my final question is that if the hallmarking has already sort of been enforced, is there any further reason beyond what Mr. Ramesh mentioned for seeing a slightly more weakish offtake in Jan? Because the entire thrust from the unorganized to organized should have started to flow through by now, given that hallmarking is in place. But is there any other reasons except for what Mr. Ramesh called out?
Yeah, so Ramesh here. So here, first of all, the January I told the momentum is high. The showroom closures have an impact. Right. And when your wedding and wedding related gets pushed to, meaning if the wedding had to happen in Jan and if it is getting pushed to March, the demand will surely be pushed to March, because as a brand, Kalyan Jewellers wedding revenue contribution is in the range of 50 to 55%.
Got it.
That's the only reason. And hallmarking, even if it is implemented from November 30th, the real impact will come when the surveillance starts being more strict and more strict implementation, which we think it will be done in the coming months, and they give some merit to some excuse to COVID.
Okay, so you're saying that hallmarking, though is implemented and infrastructure is yet in, the surveillance and it's not been it's not fully enforced as yet in the force measure that we expected because of the COVID. Okay. So we'll see more benefits of that.
The department should go and check whether they are selling BIS or fine, penalty, things like that. When it becomes more strict, then the unorganized segment will get affected more, which will be a merit for organized segment.
Done. So you're seeing that you'll see this phenomena taking place as COVID sort of settles down, and this will get accelerated in the months to come. Got it. Okay.
Yeah, it's a matter of time. Correct.
Yep. Okay. Thanks a ton. I'll fall back.
Thank you. The next question is from the line of Aniket Sethi from ICICI Securities Limited. Please go ahead.
Hi, Ramesh. So last 2 quarters, you and Titan specifically highlighted that both of you are seeing strong gains in the basic plain gold jewelry part of the segment. And coincidentally, both of you haven't really mentioned that comment in this quarter's press release. So just want to check if has anything kind of changed over there, or was this like during that point of time people didn't really want to go to small outlets, and the bigger players were kind of seeing that benefit, which is now no more the case?
So first of all, the initial thrust which we got, like the shift from unorganized to organized, it was a shocker for all of us, including the players which you mentioned, because suddenly 50-60% revenue growth, huge footfalls, major shift from unorganized to organized, lesser working hours, where lesser number of staff, where you don't get time to convert your customer or upsell your customer. You don't have the inventory which you can actually upsell, meaning to upsell for a first-time customer into studded, you need products which have less of stone and more of gold, which we were not ready with in the previous quarters, wherein it was a shocker for us. Okay, but now we really know that these set of customers are coming, and we have trained our team to upsell this kind of customer also. We have the inventory ready for them. the price is also fitting those kind of customers, and that is why the studded ratio is also improving, and the growth of studded is again better than that of plain gold when you compare Q3 of last year.
So the new assortment which you are kind of targeting for these guys, are they at a lower making charge, or are
more than
just a light jewelry?
They are of low stone, meaning the plain gold content is more. Okay, so the customer does not feel the pinch of paying money for stones because they want to actually pay money only for gold.
Understood. And you are already seeing repeat, or have you started to see repeat purchases from these new customers?
Yeah. So, and of course the margin are lesser for that kind of product. Okay, meaning plain gold minimal, meaning the minimum margin, then studded. This comes in between studded and plain gold. Even though it is studded, it is having a better margin than plain gold, but lesser than the usual studded. Just to complete your query there.
Understood.
Okay. And repeat customer, it's too early because customers come typically once a year or max twice a year. So repeat customer we are yet to actually witness, but again the gold saving scheme customer etc. are yet to come, because usually the gold saving scheme closure comes after 11 months. So we will get those kind of customers in the coming quarters.
Understood, sir. The second question is, after a pause, this year has been quite good on the store expansion bit. So if you could share your target from a 2 to 3 year perspective, this would be excluding the franchisee acceleration, whenever you decide to do that.
Yes, franchisee will be over and above our usual plan of increasing our footprint by 10 to 15%. Franchisee will only be an additional plan because that we would like to actually, that was laid to accelerate the current growth plan.
Understood, 15%. And this will be just for India, at least from a 2 years perspective?
Yes, primarily India and primarily only in non-South markets.
So Middle East will be a pause, right? At least for now.
Middle East expansion, meaning we are closely monitoring that market. The markets are behaving very positively now, but franchisee there is a too early call. There will be minimal expansion in those markets, and with the internal accruals which we have in Middle East, we don't intend to take money from India.
Understood, sir. That's very clear. Thank you, sir. Thank you, and all the best.
Thank you. The next question is from the line of Deepak Mittal from Edelweiss. Please go ahead.
Yeah, hi, so this is Deepak here.
Hi Deepak, how are you?
Hi, very good, how are you?
Very fine. So far, so good.
I was trying to say, while our margins have expanded sequentially, both in terms of gross margin and EBITDA margin and PAT margin, but when I look at, based on the last quarter 3 FY21 versus quarter 3 FY22, even though our top line has increased quite substantially, almost 15% increase, but the EBITDA margin is actually contracted. Why is that happening? Like, gross margins have also contracted, EBITDA margins have also come down substantially. Why is that happening?
Yeah, so gross margins, the reason, wherein the growth has been in excess of what actually we wanted or what actually we have. The major hit in the EBITDA margin is because of the ad expenses, where ad expenses in the Q3 of last year was only in the range of 1.4 to 1.5, and this year it is in the range of 2.5. So last year the ad expenses were very less because the competition was not spending. We were just recovering from the COVID. But quarter on quarter, the EBITDA margins and the gross margins have improved in the range of 1%. And we think that it is as per our plan of getting into the 9% EBITDA margin for this financial year.
Thank you. That's all that I had. Thank you so much. I've been listening to all your conferences and companies making a lot of progress to focus on Indian market, which is a very positive development from our
Thank you.
Thank you. The next question is from the line of Shirish Pardeshi from Centrum Capital. Please go ahead.
Yeah, hi Ramesh. Thanks for the opportunity. I have some questions. When I look at your numbers, what I find is that, I'm seeking some clarification. We have seen that employee cost has gone up about 15% on a YoY basis, and similarly, the other expenses is also shot up to 155 crore. So, is there any explanation which we can get? And more importantly, on the other expenses, what are the nature of expenses? Is that so variable that it can go up such a drastic way?
Yeah, so the employee cost, it is majorly because of a one-time bonus which we paid for completing 25 years. That was the employee cost increase and certain new stores which we would have opened. And predominantly the employee cost increase have been because of that. And there have been a one-time write-off of some assets because we relocated certain stores, and that is also in the range of 5 to 6 crores.
6 crore.
Yeah. 3 to
Can you repeat the number? 6 crore.
3 crore.
3 crore. But that's not the big number. If I look at 107 crore has gone up to 155 crore, it's a big number.
I think there has been. What I will do, I will ask the team to look at the number and call you separately. Okay?
Sure.
Because I don't. Yeah, because we'll have to check.
Okay. My second question is on the Candere. I think you've shown the impressive growth, but you can spend a minute or two explaining how this growth and what are the plans, how you want to scale this business. Because what I see in the market and the channel is confirming that this segment is really going by leaps and bounds. And again, if I look at, there are a lot of players, regional players, B2C players, they all have shown very strong growth. While our growth rates are there, but it's not sufficient, which is what we are hearing from the market.
So now, if you look at, we have grown our revenue by 40%, and our PAT levels have come down because we are now starting to invest again on employees, on infrastructure, technology, advertisements, etc., to take it to the next level of growth. So that is what we are trying to do. We are reinvesting in that business again, and we see better growth rates in the next year. And regarding the expenses, should I clarify now? I think my team is ready.
Yeah, sure.
1 second.
Shirish, the major line items within the OPEX that have increased between the 2 years is one, like Ramesh was mentioning, also the ad spend. So that from a Concall 47 crores in the previous quarter, it has gone up to about 81 crores in this quarter. And on top of that, the one-time 8 crores was the other addition. Otherwise, more or less, the expenses were in line. There's no major deviation from last year.
Okay. Thank you.
Thank you. Participants, to ask a question, you may press star and 1. The next question is from the line of Ratish Warrior from Sundaram Mutual Fund. Please go ahead.
Yeah, hi. Thanks, team. Thanks for the opportunity. Hope you all are doing well.
Yeah, thank you.
I just one question. When I heard this call, a couple of participants asked about ad spend, and how you measure that ad spend. So just one add-on question on that. Just if you can just talk about, both from South and non-South markets, how do you measure your market share, like over the pre-pandemic and now, how it has moved, both from an unorganized shift, which you mentioned, right? And within the organized, and that within the advertising spend, what we do, we can just benchmark our advertising spend with what others do, how it is in comparison. And if it is on the higher side, for example, what kind of market share we would have gained because of that. Some kind of measure, if you can talk about, it will help us then.
Yeah. So first of all, the ad spend in our sector has been in the range of 2 to 2.5%. That is the usual standard, and we are predominantly in that range. And our ads, we do not do major branding ads now because already the Kalyan brand has been established over the past many years now. So it is more of product launches, it is more of tactical ads which we do. And those tactical ads can be measured when a customer comes. And when a customer comes, we know whether it is a new customer or an old customer. And new customer, predominantly the type of product which they choose. We know whether it is from unorganized or organized. And we measure which ad has worked for organized segment, which ads have worked for unorganized segment. That is how we calculate our efficiency of ad.
Okay, and in terms of market share, if you can talk a little, between South and non-South markets, how it would have moved and what's the view there?
The line is not very clear. Can you repeat the question? Yeah, can you hear me now?
Yeah, I can.
Yeah, sorry. Regarding market share, if you can comment within the organized also, what is your thoughts, how it would have moved?
Hello?
Yeah, can you hear me? Hello?
Yes, sir, please proceed.
Yeah, so my earlier question, the second part regarding market share between South and non-South, if you can comment within the organized also, how it would have moved?
So market share growth, when the revenue grows, and we know that the market share is also growing because of two things. One is the SSG which we get from our existing showrooms, and also the revenue which we get from new stores, which again is in a new market. So the new store, all the revenue is market share growth because we did not have any revenue from that area. In the existing store, the additional revenue which we are getting when compared to the last year, that is a real market share growth.
Okay, thanks. I think I'll take it offline. Thanks.
Thank you. The next question is from the line of Ajas Lakhani from Unifi Capital. Please go ahead.
Yeah, thanks for the follow-up. Sir, I just want to understand that how do we, and I'm referring back to our franchisee model again, what are we doing to ensure that the franchisees succeed? Because, the way, at least the way we're contextualizing it is that you're using someone other person's money to, sort of grow your sales. So just want to understand that from your perspective, what do you think you need to do to ensure that the franchisee model is successful? Thanks.
Yeah, of course, that is too early to share. That is why we do a pilot franchise in the beginning to ensure that both the franchisee as well as us get the benefit. But the intention of bringing in franchise and company to manage the store is because the plan is actually accelerated. Okay, franchisee, the initial set of showrooms, if the company starts managing, it is as if we have opened the store with our own capital, meaning only the capital source is different. Otherwise, the operations is going to be the same. So that is why we are looking for that mode of franchisee in the beginning. So we were actually looking to bring franchisee on board only from the financial year 2024. We advanced it because of the momentum which we see now.
Got it, sir. Okay. Thanks, Siddharth.
Thank you. The next question is from the line of Kunal Tripathi, individual investor. Please go ahead.
सर हेलो
हाय
सर मैं हिंदी में पूछूंगा, इंग्लिश में नहीं मुझे इतना पता है. मैं आपसे सिंपल मेरा क्वेश्चन है कि मेन हमारा जो एक्सपेंशन है विद इन 2-3 इयर्स में, वो नंबर ऑफ शोरूम्स में कितना अप्रोक्सीमेटली हम करेंगे, और उसमें मतलब जो छोटे शहर हैं, जैसे कि मैं ग्वालियर से हूँ, ग्वालियर में तनिष्क है, तनिष्क का शोरूम है, और भी अदर शोरूम है, लेकिन आपका नहीं है. क्वाइट बड़े सिटी है मध्य प्रदेश में. तो सर इतने छोटे, इस तरह के छोटे शहर में जो कि टियर 1 या टियर 2 सिटीज में आते हैं, इनमें कब तक कल्याण ज्वेलर्स के वो शोरूम्स का एक्सपेंशन हो पाएगा?
So exactly this is the reason why we actually accelerated the franchisee plan. Okay, because we want to reach markets where Kalyan has a space to expand, and we don't want to restrict our expansion because of any other constraint. So that is why we have actually accelerated the plan, and hopefully we will come to your town very shortly.
सर फिर भी क्या मतलब कोई अप्रोक्सीमेटली विद इन 2-3 years में कितना भी एक्सपेंशन का आपने मतलब क्या टारगेट सेट कर रखा होगा सर?
Usually we open 10 to 15 showrooms in a year, but additional to that, we will open franchisee stores also in the coming year. So the acceleration of franchisee will actually help us to expand even faster, and we will be opening a showroom in your town very soon.
Okay, thank you, sir.
Thank you. The next question is from the line of Nilesh from Moon Capital. Please go ahead. Nilesh, your line is in talk mode. Please go ahead with your question.
Yes, hi. Sorry. Ramesh, thank you for this. Just a few questions from my end. So first of all, on the last call, you had mentioned that the plan to take the metal gold loan was to about 1,900 crores by the end of the financial year. In this quarter, it seems to me that you've gone actually the reverse. You actually reduced the metal gold loan a little bit. Any updates on that?
Yeah, Ibrahim, you want to take it?
Well, in most of the fresh purchases that we did during the quarter was by way of gold metal loan, but we had a good number of maturities of existing gold metal loan during October and November, so which has actually pulled it back a little, but our objective continues to be the same. We will take it up to about 1,800 crores. The only thing, gold metal loan that we took for the new showrooms during the month of April, that matured in the Q3, so that has actually reduced the overall count, but we will continue to increase it. There is no hurdle for us to take it to 1,800. We will. The only thing is that the existing maturities.
Are you having any issues with bank lines for the GML at this point in time?
Nothing from banks regarding gold metal loan.
Okay. The second question is, in terms of the growth divergence between you and Titan, to be specific, what do you think is driving this?
So you mean, Ramesh here, so you mean the difference between the growth rates of Titan and Kalyan?
Yes.
Okay, so one or two things which we have in mind, or one or two workings which we have, is that one, of course, we had a small issue in South India in the month of November because of the flash floods happening in Chennai and Kerala, and the market for us, which for them was not a very important market, as we speak. The share of revenue from these markets are not huge for Titan. Secondly, what we felt is that you leave aside this financial year, because Titan and Kalyan have expanded in the same rate of approximately 10%. But the 2 years before that, before the financial year, Titan would have at least grown by 25% in footprint. Okay, and Kalyan would not have, because we hardly opened 1 to 2% of our store network was expanded. And in the model which they expand by franchisee, the SSG is at its peak after 12 to 18 months. Okay, so that might be really helping them to have an advantage over Kalyan in the growth rates. Because if you see Q2 also, the same range of revenue difference was there between Titan and Kalyan.
Okay, got it.
At SSG level, we think that mature stores, we think that it will be the same way.
Okay. The other question is, you spoke something about margins, 9%, your target. What was that for? Which year are you targeting that for? Or is it for the next quarter that you're talking about?
So 9% EBITDA margin for the running financial year. That was our internal working, where we mentioned that it has been in that range for Q3, and it actually improved by 1% for Q3 when compared to Q2. And Q4 also, we expect that it should be in that range.
Okay. And the reason your number will be different from mine is because of the other income that you will be calculating as part of the EBITDA. So what was the other income this quarter bump on account of?
Other income, Ibrahim, you want to take it?
Yeah, the other income is largely the interest income that we earn from the deposit that we keep with the banks, and also interest that we accrue, interest that comes into the India account. By if you're looking at the India, then it is also inter-corporate loan interest.
What is the nature of that?
There is debt given by India to the subsidiary. So necessarily in the India books, we have to account for the interest income. But on a console book, if you look at it, that will not be there.
Okay, so the bump that has happened is because of the increased deposits which you have in the form of your customer deposits.
Not customer deposits. It is also with the deposits that we place with the banks.
Excuse me, the other income consists of many items, which include discount received, ear piercing income, gift vouchers income, insurance charges, interest income from margin money deposits. So it is a combination of many things, and all are related to our operating revenue. So that is the reason the overall other income is at this level now.
Okay, got it. And as I look out into the future, you had spoken about the fact that as your non-South contribution increases, your gross margin and your EBITDA margin potentially have got, just mathematically speaking, a couple of 100 basis points of increase possible. You still hold and stand by that view, and the kind of timeline for that 200 basis points of margin expansion that you've spoken on the last call?
Yeah, I stand by it, because you know that non-South revenue margins are higher than South, right? It is having a range of 8 to 10% margin difference between South and non-South usually. So the margin in outside South India is higher than in South, and our major expansion plans are also outside South India, which will surely improve our gross margins, which will have an impact on our EBITDA margins.
Okay, and this should happen in the next 2 to 3 years?
Yes, because all the expansion plans for the next 2 to 3 years is going to be non-South markets.
And it will be about 20 store run rate, which you've been clocking for the last few years to continue? Last year to continue?
Yeah, so that is our intention, to at least open 15 stores a year. And over and above that, the franchisee will also come in place. That is an addition to the expansion plan which we already have. That is our plan.
And the inventory will be owned by the franchisee, or inventory will be owned by the company?
Inventory will be owned by them, the franchisee.
The franchisee, okay. And final question, any thoughts on how this current quarter is shaping up? I understand there are disruptions because of COVID, but are you confident of being able to recoup some of these losses in the latter half of the quarter?
Yeah, that is what we are confident of, because last year it happened the same way, where a lot of marriages were pushed to April, and we had good demand in March. Okay, so this year also it is going to that same angle where there are weddings which is pushed to the second half of this quarter and the next quarter. So we expect that the demand momentum should be there, and the showroom closures are also withdrawn in the non-South markets. Actually, in metros like Delhi, Bombay, and Bangalore, it has been withdrawn now. And after withdrawal, we have high traction, which is displayed there.
Okay, that's good to hear. Thank you very much, and all the best.
Thank you.
Thank you. The next question is from the line of Neeraj Vijay Kamtekar, individual investor. Please go ahead.
Hello.
Hi.
Thank you for the opportunity. I have only one question. What is our same-store sales growth in South, non-South, and Middle East this quarter and last quarter last year?
So it is a very competitive data which we will not be able to reveal here.
Okay.
So SSG together has been in the range of 7%.
Sorry?
The SSG together has been in the range of 7%, the consolidated SSG.
Consolidated.
Yeah, in India.
Oh.
Middle East, everything is SSG because we have not opened any stores in Middle East over last year.
Yeah. Okay. Thank you.
Thank you.
Thank you. Participants, to ask a question, you may press star and 1. As there are no further questions from the participants, I now hand the conference over to the management for closing comments.
So thank you, everyone. See you again after a couple of months. Thank you. Stay safe.
Thank you. Ladies and gentlemen, on behalf of ICICI Securities Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect.